Economics is a very odd field. Much of it is very difficult to prove. Vast swaths of it are complex social systems that can't be fully modeled. And to top it all off, many of its thinkers consist of people who don't actually live in the real world. They exist purely in academia, in a world of their minds. For my own part, I went to school for economics and got a degree in it, and there is a line that I like to use. I'm really glad I got an economics degree. That way, I know all the wrong things people have thought about how the economy works. There are a number of competing economic schools of thought, with vast differences, ranging from labor theory Marxists to more libertarian Misesians. Yet there is one broad tent which has come to dominate modern institutions. This is neoclassical synthesis, a mixture of neoclassical economics and neo-Keynesian economics. The problem with this school of thought is that it's failed. It is inadequate, and it has led us to some poor decision-making time after time. So what went wrong? How did the institutions fail us here? And why do we keep operating on a system that does not work? Well, let's explore our economics and take a look at its effects. This is how our economics failed. Neoclassical economics began to emerge around the 1870s, during a period regarded as the marginal revolution, a period in which economic analysis was shifting away from the notions in classical economics which focused on overall costs of production and general prices in markets, and instead began to think of the margins, the additional cost to produce one more unit, the additional benefit to buy one more unit, the marginal differences between quantities. Neoclassical economics asserts that participants within an economy are rational actors who seek to maximize their utility. Utility is a rather arcane and vague concept, which can be thought of as goodness, usage to you. And that's an immediate problem. There's no strict way to actually translate utility into the real world. An example of how it's used is how much utility you derive from buying a new shirt. How much more good does it give you? Neoclassical economists assume that buyers and sellers are rational and will attempt to maximize this utility, where consumers will allocate limited resources in such a way that it will maximize their overall utility. And as neoclassical economics was really focusing on the marginal, the key point of analysis here is on marginal utility, a rational actor giving up a certain amount of money in exchange for a marginal amount of a good. How much utility accrues to the consumer via that trade-off? If I spend $5 for one single fruit, I lose the utility of the $5, but gain the utility of the fruit. How much utility marginally accrued to me in that transaction? And as an extension, so the theory goes, rational actors will continue this process until such point where no marginal utility can be acquired. At a certain point, I'm no longer gaining utility by buying more fruit, as the fruit will simply rot away and I won't be able to eat it. If I buy 5 of a fruit instead of 4, will I gain less utility from the 5th than I did the 4th? How about the 6th, 7th, 8th? At some point, there will be no more utility which I can derive, and at such point, I will cease purchasing. Concurrent to this, neoclassical economics assumes that firms will maximize profit, and again focusing on the marginal, it is assumed that firms will maximize profit to the quantity where marginal revenue equals marginal cost. If I can produce a good for $10, and I can sell one of them for $20, then I will do so. Yet say I could produce 500 of them, yet with such a supply increase, I may only be able to sell the 500th for $15. I will continue to produce more and more until I reach a point where I can produce one additional unit for $10 and sell it for $10. At that point, I will produce no more. It is assumed that buyers and sellers will utilize all relevant information, and that the value of a good to a consumer may not actually be its true utility, but is instead its perceived utility based on all relevant information, where the actor is rationally taking all of that information to derive an estimate of how much utility would come with a purchase. The result of these mechanisms working in tandem is that utility and cost of production will lead to price discovery. This is in sharp contrast to labor theories, which were present at the time. These ideas held that the labor required to produce a good was where its underlying value was derived from. Yet the problem here is that labor and price very frequently do not correspond, as somebody could spend his entire life making a good, pouring every hour of every day into it, but if there were no utility for a consumer, then it simply could not sell for that much. Meanwhile, a good could be produced as a random fluke, an absolute accident, requiring very little effort. Yet, if it were extremely valuable to the consumer, then the mediation between that production cost and the perception of utility could very well lead to it selling for a high price. Now, if any of you are considering getting a degree in economics, I hope you like lines. A major component of neoclassical economics is the relationship between supply and demand. Where all else equal, if supply increases, then the equilibrium price, the point where supply and demand converge, will decrease. Yet all else equal, if demand were to increase, then price would increase. And same for the converse forms. This model is dependent on a competitive market, where price reflects the resolution of conflict between a buyer's desires and a seller's constraints. Neoclassical economists often think about the notion of an idealized, perfectly competitive market, where, in a state of perfect competition, where no participant is able to gain a unique advantage, the aggregate effect of buyers and sellers will lead to Pareto efficiency, where no individual can be made better off without someone else being made worse off. Goods in this case will be allocated to their most valued use. This notion is allocative efficiency, and this will occur at the lowest possible cost, productive efficiency. Now, there are some immediately evident problems with this model. For one, its over-reliance on rational actors. What? Have you ever met people? So, sure, yeah, one could say that this works in theory. If we are assuming a rational actor, then this might be the case. But if there are no rational actors, then what's the point? Yeah, my theoretical model for my theoretical economy is that everything's perfect and everyone's happy. There's nothing to worry about. Well, that's not very useful. Yeah, but it's actually perfect and actually works all the time in my economy. Well, don't worry, the economists did notice this. Sort of. Fields of behavioral economics began to emerge, but only partially integrated with neoclassical. And there are just some real practical issues even if somebody were perfectly rational. That assumption that actors will utilize all relevant information is doing a lot of heavy lifting. Will somebody in a market really know if buying 200 versus 201 apples is actually where to cut it off? This may be a good general approach. Maybe I know if I want 200 versus 300, but there's no precision that this can actually work with. Take modern retail traders. They have access to so much information. They could get all the company's financials, see almost everything going on in the market. And even if one assumes that they are trading such to maximize their expected utility, how often do retail traders just buy what they think is going up because others buy it? Because it's a company that they heard about? Because it's a meme? This is not rationally using all available information. This is a very different behavior, and something that the model does not account for. And how about the factory? Economics professors love using the term widgets for stuff a factory's making. Alright, 300,274,391 widgets, that's it, no more. That won't happen. What happens if market conditions change after an order was already placed? You actually can't produce on pure margin. So much of the economy is contract-based. There's not really any place for a futures market in this model either. What are we to do with a market where some producers are hedged using futures and others are not? We could try to model these firms and markets separately, creating an aggregate interaction between them all. And this would require us to build this out at different times. And then this may be compounded by buyers being hedged with futures. And when we start shifting around transactions in time, particularly ones where contracts do not allow for buying and selling on the granular level of one unit, then the problem of informational efficiency becomes more stark. And to go further on that point, The assumption that a rational actor will utilize all relevant information assumes that actors are able to discern which information is relevant, which is very often not the case. Also, the assumption that the firm will produce such to maximize profit assumes that the utility to the firm is uniquely profit, while utility to the consumer may be something else. Yet firms produce for different reasons all the time. Firms run at a loss. Look at the tech sector today. Many firms have arms that produce at a loss for years in order to build a customer base that they believe will be profitable in the future. That is not accounted for here. This model is really an idealized notion of a simple economy. And the market is like a big agora marketplace where everyone can see the prices. And this might work in something like a very liquid stock market, but we now live in a globalized market where there are barriers, there are trade restrictions and informational friction between countries. Thus, we have seen the persistence of arbitrage opportunities. And according to neoclassical economics, there shouldn't be persistent arbitrage opportunities. So there are clearly other phenomena going on in the modern globalized economy that are not accounted for here. But this isn't the end of the story. Modern neoclassical economics has added some additional elements, leading to what today is called new neoclassical synthesis, an attempt to reconcile neoclassical economics and the economics of John Maynard Keynes. Over the course of the 20th century, the economics pioneered by John Maynard Keynes became increasingly prevalent. Institutional economists continued to hold to neoclassical models, yet came to believe that in the short term, Keynes's observations were correct. Thus, a synthesis between the two emerged: short-run Keynesian, long-run neoclassical. This model, the new neoclassical synthesis, held that in the short run, the economy operates according to Keynesian models, where wages and prices may be sticky, slow to adjust with changing economic conditions, and therefore that monetary and fiscal policy have an impact on overall output and employment, while in the long run, the economy is neoclassical, where prices and wages are fully flexible, markets clear, and the economy returns to a full employment, non-inflationary, neutral rate, with long-run models continuing to assume utility maximizing and rational individuals. We will address Keynes directly later, but one thing worth analyzing here is money creation. Within neoclassical economics, the main focus when analyzing the money supply is the money multiplier. Neoclassical economics assumes that the ultimate original source of money is central banks, which have direct exogenous control over the money supply. Within the neoclassical model, a central bank creates base money via open market operations, monetizing debt securities. Next, reserve-constrained banks which are required to hold some fraction of deposits as reserves, multiply this base money supply by lending excess reserves. When a new loan is made, that becomes the source of a new deposit, and depending on reserve requirements, the overall money supply may be larger or smaller. Say a bank has a 10% reserve requirement, holding 10 million and lending 100 million. As this occurs across banks, the overall money supply will be larger than if it were 20. Say only able to lend 100 million if 20 is held as reserves, multiplying by 10, and then 10, and so on, versus multiplying by 5, and 5, and so on. The smaller the reserve requirement, the greater the money supply. Within new synthesis neoclassical models, the same general mechanism is in play, yet the focus is shifted to the central bank's policy rate. This has a much more Keynesian quality to it, where monetary policy plays a greater role, calling on central banks to use this policy rate to manage aggregate demand. In this model, central banks will set a policy rate, and banks will make lending decisions based on that rate. Banks will again create deposits by lending, and central banks will accommodate reserves, ensuring that the banking system has enough reserves to settle interbank payments and maintain the target rate. Here it is assumed that the supply of reserves is endogenous to the system, while the interest rate, controlled by the central bank, is exogenous. The major shift that happens here is that money is no longer as important as it once was within older neoclassical models. money becomes informational, and really only in the short run, as in the long run it should be neutral, with real interest rates being what actually matters, as the interest rate will affect lending and borrowing decisions. The nature of money creation is a very tricky topic, as the actual credit markets of our modern world are far more complex and bizarre than any of these simple models can accommodate. One way of thinking about the money supply that gained great prominence in the 1970s, though never quite became dominant in institutions, is the monetarist school of thought, which emerged in the University of Chicago and is particularly associated with Milton Friedman. Monetarism holds that the money supply multiplied by its velocity, the movement of money through an economy, is equal to the overall price level times the quantity of output, the total output in an economy, where that price level times quantity side of the equation is equivalent to nominal GDP. Thus, money supply times the velocity of money is equal to GDP. Monetarists assume that velocity is stable and predictable, and that it is determined by institutional and technological factors which are slow to change. Thus, monetarists largely ignore this, treating it as a constant, as it is constant in the short run and predictable in the long run within their models. This has led to the primary assertion from the monetarists: inflation is always and everywhere a monetary phenomenon. The thinking goes as such: in the long run, output is determined by real factors, such as technology, resources, and labor, and therefore any long-run increase in the money supply, which is greater than the growth in quantity produced, must lead to an increase in price. And this certainly appears to be true. If you were to flood the economy with money at a rate faster than the economy is growing, you would almost certainly see inflation. Yet, this isn't quite a complete picture, and there are a few more assumptions in here. Monetarists assume long-run monetary neutrality, where in the long run, an increase in the money supply will only affect nominal variables, such as prices and wages, but will have no lasting effects on real variables, GDP, employment, or the real interest rate, as the economy will settle back to a natural rate of unemployment and full employment output. Yet in the short run, monetary non-neutrality is assumed, as prices and wages are sticky. An increase in the money supply can temporarily affect real output and employment. Thus, this is the basis for the temporary trade-off in the Phillips curve. It is thereby concluded that government intervention and monetary policy will often destabilize an economy, leading to an instruction, often termed the Friedman rule. Central banks should target a fixed monetary growth rate, equal to the expected long-run growth of real GDP. Meanwhile, it is also argued that fiscal policy is ineffective, as it causes a crowding out effect. As public spending increases, increased demand for credit will emerge with it, and thus an increase in real interest rates. This will in turn discourage private investment, neutralizing the stimulus. Or said more succinctly, there's nothing that fiscal stimulus can actually accomplish, so most likely it's just going to cause unnecessary problems. There are many problems in neoclassical economics and Keynesian economics that monetarism solves, yet it leaves us with some new ones. For one, the assumption that the velocity of money is stable. Why? It isn't capable of accounting for sudden shifts. Additionally, the assertion that money is always causal. Is it? In the long run, output is determined by real factors. That assertion seems generally true. However, the supply and demand for money is much more complex in the modern financial system, much more complex than it was even in the 1970s. And we will get to today's credit system in a moment. But there are a few key sectors of the economy that can have an outsized effect that, while this model doesn't fully reject, doesn't have a very strong way of handling. For example, energy. A question to consider. What is actually going to affect oil prices more? The aggregate supply and demand occurring in the market for oil, the market between all of those participants every day, everyone at gas pumps, people running factories, shipping companies, commodities traders, etc., or the sudden geopolitical needs of the Russian state. How about a religious revolution in the Middle East? Or perhaps the collapse of a major South American oil producer government? Now, many of the deeper problems with these schools of thought will become evident once we look into the modern credit system. Yet, before we leave monetarism, let's go back to that assertion of the stability of money velocity. Institutional and technological factors are slow to change. No, actually, quite often technology progresses in fits and starts, and institutional changes can happen overnight. Think about the toppling of a government, or the world's largest bank suddenly adopting a new computer system, requiring their competitors to match it within weeks. And what about behavioral changes? In the long run, the money supply will have no effect on real variables. Are we sure about that? Because if there is sufficient inflation in a system that has lasted for years, not even the long term, still call this short term if you want, that will have a psychological effect on the overall economy, quite likely changing behavior. It's all just the money supply. It doesn't actually account for humans. So while I have to credit the monetarists for solving many problems within neoclassical economics, it just doesn't quite get there. It's like wrapping the neoclassical pill in bacon for libertarians to be able to swallow. And oh, just one tiny thing. GDP is kind of meaningless. When the government's the largest borrower, and GDP counts government spending, what are you counting? So how do the monetarists view money creation? Within their framework, where does money come from? They as well focus on central banks, as well holding that central banks have direct, exogenous control over the money supply. And same as the neoclassical model, monetarists hold that this is done via open market operations, specifically through the purchase of government bonds. This model really focuses on sovereign debt securities as the basis for money. This model holds that when a central bank buys bonds, it credits the selling bank's reserve account or issues new currency, which is true. This immediately either increases reserves or the supply of currency, thus increasing the money supply. Next, commercial banks behave as the money multipliers. During this process, a commercial bank will receive new reserves. It will retain its required reserves, and it will lend its excess. When a central bank originates a loan, it will create a new deposit in the borrower's account. The borrower will then spend that, deposit it into other banks, and this process will be repeated. Thus, the money supply is a fixed multiple of the monetary base, where the money supply is equal to 1 over that reserve requirement multiplied by base money. This really misses a lot. Its broad stroke mechanics are correct, but it really misses a lot. The money supply is not the base money times a fixed reserve requirement. That just isn't our modern system. The modern system is an enormous network of shadow banks, and a whole lot of US dollars get made in offshore banks, not regulated by the Fed, and often able to rehypothecate money over and over and over. We will keep coming back to this issue, but to introduce this topic, let's look at the broad Eurodollar banking system. Following the Second World War, Europe was in bad shape. Much of its capital and infrastructure was destroyed, as the British ruling factions had become so closely intertwined with the Americans. The Anglo-American relationship was close, and the Americans gave Britain an opportunity, the ability to create US dollars. Initially, this could be done as such. A British bank would hold US treasuries and make US dollar loans. This was quite simple at first, allowing British banks to function like American banks. Yet over time, this system would become enormous, and the reserves held by British banks wildly inadequate when compared to American reserve standards. Thus, when we look at models like the monetarist one, where money supply is a multiple of the reserve requirement, this falls apart completely in the modern market for US dollar credit, as there may be reserve requirements in US banks, but as the 20th century went on, more and more of the US dollar supply was being created via credit in the offshore banking system, which did not have the same reserve requirements. And additionally, that could be multiplied more and more as well, as rehypothecation requirements are quite different in other countries. someone in the United States might see the idea of taking out a loan to buy a stock and putting that up as collateral to buy futures, putting that up as collateral to buy options, and using that to buy gold, and say that that's a completely absurd premise. Yet it is perfectly acceptable in other countries. Thus, that simple model of base money multiplied by 1 over the reserve requirement is completely untrue, and is a painfully naive version of how actual credit creation occurs in the modern global economy. Over time, the offshore dollar market became enormous, with foreign banks gaining the ability to create US dollars whenever they want. And while one may point to the Federal Reserve and say that surely the Fed must have a control on the money supply via policy rates, as US dollar credit came to become priced in LIBOR internationally, a dollar rate set by London banks in the Eurodollar market, and not American banks in the US dollar domestic market, it became such that with very inadequate reserves and high levels of rehypothecated credit, strain in US dollar credit would hit the offshore dollar market much more heavily than it would the domestic. And as demand for US dollars would spike much more sharply in the offshore markets, the LIBOR rate would spike much higher than the Fed rate, leading to a situation where the Federal Reserve may raise interest rates 50 basis points, but LIBOR will jump to 100. And thus, as credit in the United States was based on LIBOR, US dollar rates that people actually interacted with in the US would spike as well, meaning that the demand for US dollars created by foreign banks, in the end, had more of an effect than the Federal Reserve. So the central bank model doesn't even work. But paying particular attention to the Federal Reserve, let's take a look at the economics of John Maynard Keynes. Keynesian economics views aggregate demand as the primary driver within an economy, where total spending in an economy is the primary force determining the overall level of economic activity, overall output, GDP, which as a note, history has shown us that GDP really isn't a good metric, and employment. Within Keynes's thought, this is particularly true in the short run, hypothesizing that when aggregate demand falls short of the economy's potential output, it will lead to recessions and heightened unemployment. Keynes focused particularly on the short run, noting that prices and wages are sticky in the short run. The mechanism he proposes for this is that when demand falls, firms will reduce production, and that they will tend to prefer to lay off employees rather than lowering wages or prices. This in turn prevents self-correction and prolongs recessions. He believed that capitalist economies are inherently unstable and prone to episodes of underemployment and recession. One very notable thing that he added to the economics discourse was an increased emphasis on the psychology of market participants. He proposes that investment is driven by animal spirits, psychological tendencies toward greed or fear, and that during a downturn, pessimism causes investment to collapse, creating a vicious cycle of low demand, low output, and low confidence. This isn't entirely at odds with the rational actor hypothesis, but certainly accommodates actual psychology to a much greater degree. He posits that a change in spending, whether public or private, has a disproportionately large effect on overall national income, as stimulus will be magnified via a money multiplier effect. He argues that therefore, government intervention is necessary for stability, and that the government should engage in active fiscal policy to boost aggregate demand during a recession. There are many things to note here, and I certainly will not be able to go through all of the objections to Keynesian thought. But for one, he argues that firms would rather lay off than change prices or wages. This isn't entirely true, and it also insufficiently captures modern technology. It additionally doesn't accommodate mass layoffs during boom times either. For example, what we have seen in the tech sector. And in fact, there are many instances where firms do lower prices, even when not doing layoffs. So it isn't that he is necessarily wrong per se, as we do still certainly see the decision to lay off during recessions, and it is largely true that layoffs are preferable to wage cuts. But there's a great degree of nuance, and a nuance that's particularly been amplified in the modern technological environment. And if we work strictly within this model, it's not going to very well capture the things that we see. leading us to responses that may not align with what is actually happening. Yet the larger issue is this utilitarian engineering the market ethos, the idea that the government should stimulate the economy in recessions, and that fiscal and monetary policy should be used to smooth the boom-bust cycle. That just turned out to factually be wrong. The opposite happened. That just did not happen. As what we actually saw emerge was that monetary and fiscal policy interventions, at least in a great number of instances, prolonged recessions, elevated boom times, and overall just made the wild swings worse. Here's a very interesting example to think about, and brings financial markets into it. Back during the Clinton administration, everyone was waiting on a big report, looking to see the state of the economy. Stock traders and bond traders alike, all waiting on the edge of their seats. Well, the numbers came through, and the economy was doing far better than expected. Thus, what should one expect? One would think that stocks should rise. However, what instead happened is that bonds sold off, but this was in anticipation that the probability of a Fed rate cut was now lower than had been priced in to the futures market. And as the yield curve shifted up, stocks sold off. Yes, there is certainly an effect that the Fed can have on the monetary policy end, but it can very often have a counterintuitive effect once the actions of market participants are factored in. Using this counterintuitive example to illustrate the point of actual market behavior. Additionally, the over-reliance on monetary policy has led to attempted uses that can't actually work. For example, if inflation is being driven by things like food prices, well, raise the interest rates all you want, people are still buying food, because the credit supply isn't actually a constraint on people buying food. So aggregate price level is actually a very poor choice of what to look at. Every good must be considered as a separate market, and trying to engineer the economy as one big GDP figure, along with something like CPI inflation, just does not work. Now, at the time when Keynes was originally putting forward his ideas, he was focusing more on fiscal policy than monetary, although he did note monetary policy. And this has proven to be even less effective, as it turns out that the monetarists were generally right in this regard, that big direct injection style stimulus is counterproductive, yet simultaneously the economy that we have emerged into in most of the West is one that has become dependent on government spending. And something very tricky happens once the government becomes the largest debtor in an economy. If we think back to the original way that the Federal Reserve operated, it was intended to backstop the commercial paper market, and not the US Treasury market. Once the Fed became the backstop for the Treasury, and the permanent monetizer of US debt, the entire model by which we must think of fiscal and monetary policy changes. Say, for example, interest rates were to rise. Well, as government debt has become so enormous, with the government as the largest borrower, raising interest rates will actually increase the demand for credit. Why? Because the government will have higher interest rate payments to meet, and in a Triffin dilemma world where the government must constantly borrow to liquefy international markets, it will continue to do so, and it will go deeper into debt in order to make those interest payments. Thus, the higher the rate, the higher the interest payments, the more the government must borrow, the more the Federal Reserve will monetize. Now, before we go on to post-war Neo-Keynesian economics, I do want to give particular credit to John Maynard Keynes, as most of the economic thought that we are looking at has come from ivory tower academics cloistered away from the real world, existing entirely in theoretical worlds only extant in their own minds. Yet Keynes was a genuine participant. He was a Bank of England director and a very skilled trader. It is also worthwhile to point out that while picking apart these economic theories, this is nearly 100 years later. The economy looked very different at this time, and much less was known. Using another example of the Austrian economists, I like to give great credit to Ludwig von Mises, as he was a very intelligent economist. He had fantastic ideas, yet he was describing a 19th century economy. And while he should still be an influence now worth thinking about, if you try to operate off of his models, there's going to be an enormous amount that you miss. Economies change over time. We learn new things, we get new technologies, new financial systems, and sure, some things may be timeless, but trying to use the ideas of an economist from generations ago and apply that to today is almost certainly going to fall short. So let's look at the post-war Keynesians, the Neo-Keynesians. These economists largely thought in the same mold as John Maynard Keynes, yet they wished to formalize his ideas. They believed that macro phenomena could be modeled using tools like investment saving preference money supply and the Phillips curve. They were seeking simplified and testable structures to study the interactions between the goods market, the IS curve, and the money market, the LM curve, attempting to demonstrate how government policy could shift output and employment. Over the following decades, new formalized concepts would emerge, creating models for things like wage and price stickiness. They would propose ideas like the money illusion, an idea originally proposed by Keynes himself, where participants in an economy mistakenly look toward the nominal value of money, misestimating its value, which should be viewed in real terms. Long-term contracts, the idea being that some stickiness is slow to adjust, because participants have already entered into contracts. For example, wages won't change this year because they can't until next year. Or I have already agreed to buy this many barrels from you for the next 6 months at a set price, and that won't change until after the term of the contract. This, I think, was a particularly good addition, as well as coordination failure. An example of this being that companies should all raise their prices all at once, and if they were to do so, they would all end up in the best place. Yet, because they cannot coordinate, no individual company can risk being the one to do so. And as they cannot coordinate, economic conditions that do not make sense persist, or companies find other means to get to the outcome that they require. A very defining feature of the Neo-Keynesians is the absolute focus on the demand side, paying really stunningly little attention to the supply side, something which is a major problem with Keynesian thought. And much like John Maynard Keynes himself, the Neo-Keynesians have continued to advocate for strong government and central bank intervention. Again, the biggest problem here is that it just does not work. These models are grossly simplistic. It has a very inaccurate view of how money is created. It accounts very poorly for how money and capital markets actually respond, and just empirically, it failed. This has largely been kept alive because the government likes it. It provides an excuse for why the government should keep borrowing and spending. I can't prove a counterfactual, but I feel pretty safe saying that if it weren't for the needs of politicians to justify their spending, that this school of economics would have died decades ago. It just bears little resemblance to the actual world, and has been useless for a while. But it's a justification, so it hangs on. Modern financial markets are enormous, shadowy, and arcane. There is absolutely no way that I can claim to understand how they work, for they are complex systems that no single person could possibly understand. Ownership has become layers upon layers of derivatives and hidden wealth. Nobody even knows how much money there is. Attempting to build a model for this system, especially in light of every participant being a uniquely irrational actor, is an impossible task. But that doesn't mean that we shouldn't attempt to build reasonably useful models. The modern shadow banking system, for example, has led to a situation where the true market for US dollar credit, including US dollar credit creation, the money supply, cannot be fully understood nor mapped. New credit is being created all the time through rehypothecation transactions. For example, private credit lender A, in some European country, originating a loan to a financial company in Asia, who uses this to purchase precious metals which are used as collateral in a bank in India, which in turn originates a loan for them in Indian rupees. Those Indian rupees are then exchanged to Japanese yen, which are used to purchase stocks in Tokyo, which are then used as collateral in Singapore for a loan from another private credit company. There's no way. It's just ridiculous. There's a reason there are much more strict hypothecation standards in the United States, because we may be loose with the money, but we don't want to be entirely nonsense. The ultimate problem is that economies and financial markets are complex systems. They are complex because they are the aggregate result of millions and millions of people interacting every day, all with motivations that may not even be understood by themselves. I don't have a perfect economic model, so I don't mean to be too harsh when I say that our economics have failed us. Yet all the same, they have failed. While I can't present a contrary model that solves every problem everywhere, I do believe that there are a couple avenues that we should pay particular attention to, one of them being the psychological dimension. This is of extreme importance, as the decisions of market participants really come down to what they think. For example, the ability for a stock to become wildly overvalued simply because of investor confidence, bearing no resemblance to the actual underlying conditions. Additionally, it appears to me that the models we use should have an evolutionary component. Much of our economics relies on linear relationships. A leads to B leads to C, very often proposed to be cyclical. A leads to B leads to C leads back to A. And while we do see phenomena like this, we also see deviations, like a mutation, where A leads to B leads to C leads to A, and perhaps the cycle repeats again. Yet at some point, whether it be a change in technology, a change in politics or social ordering, or simply participants having seen that pattern play out before, there will be a deviation, where those who would have engaged in C upon seeing A leading to B will cause D to happen, thus resulting in A leads to B leads to D. Perhaps this has a novel effect. A leads to B leads to D leads to E, and so on, as patterns can repeat, yet they can also evolve. Fundamentally, another major issue is that our metrics and models just aren't very good. GDP, CPI, they're rather meaningless numbers. Think about inflation for a moment, particularly when we look further back into the past. It is very difficult to try to get an approximation of what things were worth relative to today. People will often look at something and see its price in the past, then use a simple CPI calculator to say, it's like this much today. But what does that mean? How can you really say what the Dutch East India Company is worth in today's money? The economic function that it fulfilled is completely different from anything that we have now. Perhaps you can compare a good relative to average annual wages. Then you can at least get a relative comparison by purchasing power. But this is still missing a lot. Other times people try to compare goods to gold, but this can't quite work either, as the significance of gold changes over time. Indexes like CPI, for example, they try to track baskets of goods that are commonly used by people. How much does it cost to buy that basket in the past relative to now? And the immediate persistent issue that has always been the case with this is that the goods people buy change. So, typically, they've attempted to find substitutes. Perhaps when the horse-drawn carriage goes away, it could be replaced instead by the car, since it's fulfilling a similar function. But this isn't quite right, at least in a great number of cases. One problem: sometimes people go between substitutes, not because it is actually filling the role that a good used to in their lives, but because they have been forced to. For example, say people usually buy very good artisan bread from a baker, and then they begin buying cheaper, mass-produced loaves. Perhaps this occurs at such a level that those artisan bakeries begin closing down. Inflation data could look at that and say that bread has gotten cheaper, seeing that people have simply substituted the old way of getting bread for the new, cheaper way. It's fulfilling the same role, thus costs have gone down. But really, people have all moved to a lower quality good because what they used to buy is now so much more expensive. In reality, prices have gone up, even if they're spending less. And how about changing tastes? You can't cleanly say that one good is a substitute for another if tastes change. Have hats gotten cheaper because people no longer buy tricorns and top hats, and now simply buy baseball hats? Is that really what happened? And how about technology? Say a lot of the population begins paying subscriptions for large language models, using it for the same purposes that they previously were using free search engines for. Should we really say that the cost of internet utilities has gone up? They're using a new good for generally the same function, and now paying more for it. Did internet search inflation occur? Or is this something very different? The more you think about this, you will find more examples. Changing tastes, changing economic needs, changing behaviors. the role that certain goods fill within an economy. There isn't actually anything to compare a Dutch East India Company to. So these metrics, they just don't work, even if there weren't so much fiddling. All of these problems are quite serious, even if they largely exist in the realm of the abstract and the academic. Our economic models have enormous implications for government and bank policy. Because of our reliance on Keynesian thought, we have found ourselves in a Triffin dilemma world, where the government finds that it must keep borrowing more and more and more, not simply for the pet projects of legislators and constituents that must be appeased, but because we have built the economy around fiscal stimulus, and we have built the economy around credit markets being dependent on an ever-increasing supply of treasuries. If we were to simply stop fiscal spending now, in a large and sweeping cut with no replacement, then we would find that much of the economy would crumble, as so much has been built around Keynesian stimulus. And the credit markets themselves, the offshore dollar markets, depending on a base of treasuries to keep itself running. While that has become the system by which the US dollar operates, our models don't reflect it. Our models have led us to act in certain ways, causing problems. Yet, because of the limitations of those models themselves, they're problems we don't truly understand. Comparative advantage and absolute advantage have been two concepts fundamental to globalization itself. While the offshore US dollar market has been the fuel propelling the globalized economy, the theoretical notions of advantage have been the justification for the great offshoring, international supply chains, and focused national economies. The idea of comparative advantage is that of all possibilities, of every good a producer could produce, or that a nation should base its economy on, the trade-off between opportunity cost of not producing another good and the advantages accrued by producing a good must be weighed. The good which gives the most benefit relative to its opportunity cost is the good which should be produced. For example, of everything that I can make, I gain the most benefit by growing corn, a benefit which makes not producing anything else worthwhile. While absolute advantage is the advantage that a producer has in producing a particular good, an advantage compared to every other producer. For example, my economy is particularly good at making clocks. Of everywhere in the world, I am the best and gain the most benefit relative to the costs to do so. Therefore, my economy should produce clocks. These notions have led to the globalized world of today, where countries look around and say, the best place to acquire labor is in a foreign country. Therefore, I should move my labor force offshore. Or perhaps the supply chain should be changed. I could easily buy a component from a factory nearby, but it would be most efficient if I were to buy from a company across the world. This has led to global supply chains, where most countries in the world are not set up to take care of themselves. This has led to capital being concentrated in some countries while labor in others. This all sounds very good on paper, make things the most efficient way regardless of where they are. But this is a perfect example of why our economics have failed. It is very theoretical and abstract. It views everything as numbers. It has no concept of what a nation is, what people actually care about. It genuinely believes that people are willing to see their towns destroyed if it means marginally there are cheaper appliances in Walmart. It is so completely unhinged and detached from actual humanity. It just doesn't see any reason why being dependent on a foreign adversary for key components in your supply chain might be a problem. For our economics, everything is a theoretically perfect world which can be modeled on a spreadsheet. One where factories make widgets, and where humans are themselves widgets. It has built a system of alienation, a system where nations can no longer take care of themselves, where the idea of building up an economy around your home and your people is seen as quaint and antiquated. Why should you care at all about your home when you can derive marginally more utility units from across the globe? Perhaps cheaper TVs in Walmart are nice, yet clearly this way of viewing utility has been entirely wrong. As if this truly were what people derived utility from, then we should expect to see quality of life increasing, people becoming happier, and for the overall world to be more efficient and smooth. Yet we have seen fracturing, alienation, crisis when there are slight supply chain hiccups. We've seen a single boat getting stuck in a canal, causing a global catastrophe. Towns destroyed, families estranged, and people just becoming more miserable. Our economics have failed not because its thinkers were unintelligent, but because they were trying to abstract away humanity. Because they never understood people. They never understood why we do the things we do. And because they thought too linearly. They couldn't see counterintuitive causes and effects, how systems evolve over time, and what real humans do in real situations. Thus, we've built a world of atomized individuals, where the most important thing is GDP, and where hopeless people in destroyed towns are told that they just don't understand, because the line is going up. And while I don't have all of the answers, we certainly do appear to be entering into a new economic and financial era, with a different international market ordering. And if we are going to execute on this change, and build a system more adapted for our future, it is going to be incumbent on our economic thinkers to break the molds of the 20th century. I don't know what this will look like, but one thing does seem evident. We are due for a change.